Okay, we're just letting folks join the session. Before we get started, it takes a few moments for everybody to jump into the room. I realize I'm supposed to have my official background up, so I'll put my official background up. Okay, it looks like the attendee, oh, no, maybe not. I was gonna say, it looks like the attendees are slowing down, but. Okay, why don't we get started? Good day, everyone. Good morning, everyone. And thank you all for joining us. My name is Patrick Sullivan, and I'm the President and CEO of the Halifax Chamber of Commerce. And it's my pleasure to welcome you all to today's Navigating COVID-19 webinar series with our experts in business resilience from Deloitte. Over the past several weeks, we've been very focused on communicating with our members about available funding programs and other resources and support for your business. But in the coming weeks, that focus will shift to the recovery phase. And that's why we're so thrilled to have Deloitte here today to talk not only about business resiliency, but how local businesses can recover and in fact thrive as we move to what will be the new normal. So now it's my pleasure to introduce our speakers today. Sheri Penner is Managing Partner Atlantic at Deloitte. Sheri manages Deloitte's marketplace activities and brand throughout the region, working closely with their team to serve their Atlantic clients. As regional managing partner, I guess that's what RMP is. She also serves on the Canadian firm's management executive team. Katie Rogers is Deloitte's Atlantic tax and legal leader and serves on the national tax executive. With 15 years of experience, she has worked with many of Atlantic Canada's largest privately held companies and their owners, as well as public companies and small to medium private enterprises. Welcome, Katie. And last but not least, Brian. Oh, I only heard this once, Brian. So I'm gonna destroy it. But Brian Stewien. I'm sure I got it wrong. Brian can fix that as we move forward. And Brian is a partner with Deloitte's Value Creation Services practice. He has 20 years experience assisting clients in creating and accelerating value. Brian specializes in driving EBITDA and optimizing cash flow by advising on revenue growth strategies, margin improvement, cost reduction, and working capital best practices, all of which we could use advice on. We will have time to answer questions at the end, so feel free to ask your questions in the Q&A box below. So I think you can see Q&A at the bottom of your screen. You can click on that. You can ask questions. Sometimes people confuse that with the chat function. There's also a chat function, but if we could focus on the Q&A, that would be great. I would encourage folks from Deloitte to look at both those boxes. If you are commenting in the chat box, there is a reminder to address your message to panelists, which will only be seen by presenters and myself, or to panelists and all attendees. And I would encourage you to do that. So encourage you to address it to panelists and all attendees if you feel the need to use the chat box, which what everyone will be able to see. So Sheri, Katie, and Brian, thank you all for joining us. And I'll turn it over, I think, to you now, Sheri.
Yes, thank you so much, Patrick. Can you hear me?
I can.
Excellent, great. Well, thank you, Patrick, and also Sandra and Chris and the whole Chamber team for inviting us here to speak with you today. COVID has been a very steep learning curve for all of us, including Deloitte and our clients, and those of you, I'm sure, on the phone. No one's escaping it at the moment. And so throughout the past 7 weeks since we closed our offices here in Atlantic and across Canada, we've been working through a number of crisis response issues, and we've learned a lot. We've learned a lot from our own experience, as well as our other firms in other countries, their experience, and our clients. And we're sharing it now as best as we can, as real time as we can, both through online and webinar experiences and through things like this. So we've been doing this in Atlantic, and we really appreciate the opportunity to do that, and hope that we're helping the community in that way. Part of our global research throughout this process has included our experience with our other firms in China and Italy in particular, which are both ahead of us and experiencing similar issues, but ahead of us in terms of their response and recovery. And so what we're seeing there has helped us. Our framework for understanding this the COVID response, including executing strategy and how businesses can best respond to this, is really centered on the concept of resilient leadership and how leaders can execute during this time to get through such a prolonged crisis. So for us, that includes thinking of the crisis in a business continuum that's based on planning for the response period, which we are in and have been experiencing for a while, the recover period, which hopefully we are also entering and starting to plan for if we haven't already, and then eventually when this is over, we know there's another period of what's going to happen to all of us in the new normal, and we like to term that thrive, because that's our hope to give the best advice and strategy for thriving at the end of all of this. So most of us on this call have already worked through some sort of a response at this point, whether we wanted to or not. That's been the reality for the last 7 weeks. And hopefully that included the development of some sort of command center to make decisions. I'm certain that you've all thought about cash flow planning and how to weather the storm through the period of time that we need to weather it. I'm sure that you've dealt with workforce planning like we have, and every company, whether they're essential service or non-essential, and having to figure out remote work at this point, or no work at all, quite frankly. That's been an issue for everyone. And then there's client communications, how to stay in touch with people in this type of an environment and instill faith and confidence. And then finally, securing supply chains, whether it's for now or whether it's for the future. And that has become a challenge for a lot of people, including our government, as you will have seen probably from the news. So hopefully recover is also underway for most of our businesses in Atlantic, or at least in congruent planning with the response work. The recover period really has other elements of decision making included in it. And as we consider cost reduction levers, what types of things are going to be needed over the next couple of months, as more and more information has become available, it's clear that this time period is longer than probably was originally expected or hoped. And so there will be an impact to that needs to be considered in this recover period. There's also return to work protocols. The last week especially has seen a lot of talk about return to work with the government, and we certainly at Deloitte are spending a lot of time around the planning for that. What does that look like? And it's not as simple, when we shut down, it basically within a few weeks that decision was made and it was done. I think the return back, we're all realizing, is going to be a longer process with a lot more structure around it. And then of course, looking at the government's assistance programs, which we'll talk about today, which have been announced sort of regularly over the past few weeks and are now in play for actually impacting us, and that process is part of the recover period as well. But the businesses who will truly thrive at the end of all of this are also thinking about the future, and they're thinking about new models for their business. They're thinking about living their purpose through the decisions that are being made right now, and how the structure of decision making is built on some sort of a framework and not just reactive. And they're also thinking very hard about tech enabling their future in a more significant way than I think we've been forced to think about it in the past. So we believe that with the right leadership and with this approach to the decisions that need to be made right now, that companies will be able to achieve all of this and come out at the end of the crisis even stronger. And so that's what we're aiming to do with a lot of our advice right now and our work with clients. But in today's session, we're going to focus on a couple of areas of that decision making, and specifically around cash flow. So cash flow in and cash flow out, and making sure that a lot of the learnings that we've had around that are passed on to you in terms of tax and incentives, as well as cash flow management and optimization. So as Patrick mentioned, I have two of my partners on the phone with me. Katie Rogers is our Atlantic tax and legal leader, and she also sits at the national table of our tax leadership in Canada, and has been at the forefront of our response to COVID from a tax perspective, which has included very rapid development of planning for companies that are going through this, and a playbook around what are the best decisions to be making around tax right now. And then on top of that, the incentives and the government programs that are are flowing daily almost, and what those mean and how they can be interpreted. It's a very different time in tax. For those of you that have been around, usually it takes months, if not years, to make decisions and roll things out, and there's a lot of technical behind it, and now we have to deal with things on a day-by-day basis. So Katie and her team have been doing a lot of work, and she's got a lot to share. I'll ask her to share, and then following her, Brian's work with companies around working capital, it also contributes to our cash flow discussions and a lot of decisions being made there. So we're going to start with Katie. And so Katie, I'll ask you to kick things off, just talking about, you know, why are we even talking about tax now? In some ways, it seems like something you wouldn't be talking about, but to the contrary, it has a big role to play.
Yeah, absolutely, Sheri. Because of the cash flow constraints that a lot of companies are facing, they're looking at all aspects to look at how can I get more cash in and how do I prevent cash going out. And Brian will speak about that from a much broader perspective, but tax does have a role to play. On my first slide, I sort of break down tax considerations into 4 groups. So the first one is ways to maximize cash, and the second one is ways to minimize the cash that's going out the door. I'll talk a bit about government funding, which you mentioned, and then the last one is the long-term planning. So as we turn our attention to the Thrive, what's happening right now and how do we set ourselves up to enhance and protect shareholder wealth going forward. So the first point there, the maximizing current cash. So there's a few things to consider, and these ones are relatively simple. Sheri did mention a playbook, and we as a firm do have a national tax playbook. It has over 70 ideas in it. A lot of the ideas are for companies that have activity cross-border. So I picked the ones from the playbook that I think are relatively simple and would be applicable to all companies, but there are so many more things beyond these ideas. So the ones that I've got here and I wanted to share with you today, the first one is very simple, and it's the recovery of prepaid taxes. So companies that have a calendar year end, they have until June 30th to file their tax return. And what we're telling a lot of our clients is if you overpaid on your taxes for 2019 and you're expecting a refund, get that tax return filed as soon as possible to get that cash in the door. The second item is with respect to looking at all of the assets that you hold, and with the decrease in value in the market, do you have any assets that are in a loss position now that you could sell or realize that loss and then carry that loss back to recover taxes that were paid in the last 3 years on any gains, for example? And then the third one is this idea of accelerating large tax refunds. So a lot of companies would have been profitable in the last few years, and now this year, because of COVID-19, are suffering significant losses. So at the end of the year, they'll be able to carry the losses back and recover taxes paid in other years. But the problem is companies need that cash now. So accelerating the tax refund is all about finding a way to trigger a tax year end sooner rather than later, so that you can carry the losses back and get the cash in sooner. For those companies that haven't filed their 2019 tax returns yet, you should stop and look to see that you have captured all of the deductions that you're entitled to. Some of the areas to pay particular attention to would be accounts receivable and inventory. Because of what's going on in the market, there may be an opportunity to take additional deductions because the valuation of those items have decreased. So for example, if you had an amount sitting in your accounts receivable in December and it's still sitting there now at the end of April, there's a fairly good chance that it's not going to be collectible and that you could claim a deduction for it in 2019. A number of companies also carry life insurance policies within the corporation, and sometimes those policies have significant cash surrender value attributed to them. So there are ways to get access to that cash in a tax efficient manner if you need the cash within the business. In terms of minimizing the cash that's going out the door, I'm sure most, if not everyone, has heard that tax installments can be deferred until after August 31st. So immediate suspension of all of those payments will help minimize the cash going out the door. And beyond that, when the installments do become payable again in September, it's important to actually understand what your tax position for the year is going to be and recalculate what your installments need to be. If you're in a loss position this year or will have significantly less income, then the installments that you have to pay will be reduced. We also have a number of clients who are looking at different compensation packages. They're looking for opportunities to reduce the amount of cash that has to go out the door, but also continue to motivate employees. So there are a couple of different strategies available. There's deferred compensation packages, there's stock option plans, there's phantom stock units. So there's a lot of different compensation strategies that may not have been considered in the past, but are all of a sudden becoming more relevant, even for private companies. And again, the maximizing of deductions. So again, if you haven't filed and paid your 2019 taxes yet, looking at those deductions, looking for opportunities to maximize them to prevent the amount of cash you have to pay for your final balance. The government funding, I'll talk about after because I've got another slide purely dedicated to that. So I'm just going to skip over that for a minute and talk a bit about the long-term planning. So given the values today compared to what they would have been just a few months ago, there's likely to have been a significant decrease for a lot of companies, as well as in portfolio investments. So now is a really good time to look at, for anyone who's contemplating estate planning or has already done an estate freeze, now would be a good time looking at whether or not you do that initial freeze or do a refreeze even. We also have a lot of companies who are looking at ways to protect the wealth that they've built up in their companies. So any company that has a significant retained earnings balance, we highly recommend paying a dividend up to protect that wealth. And finally, a lot of companies also have intercompany loans going back and forth. Given this environment, we also strongly encourage companies to secure those intercompany loans. So we'll go now to my next slide, which does summarize the government programs and incentives. And they have been flying out wildly, both at the federal level and provincial levels, as well as in some municipalities. So it is a full-time job to stay on top of all of these. And what I've tried to do to make it a little easier to digest is break the different programs into 5 groups. So the first one is improving cash flow. And these are the programs that are designed to stop cash that's going out the door. So a lot of these are all around the deferrals that are available, the deferral of corporate tax payments, the deferral of workers' compensation premiums, and in some instances, deferral of property tax, for example, or deferral of payments on government loans. The second group is those that are true savings to companies, either in the form of a subsidy or a credit or a grant. The third one is access to financing. So these would be the programs that offer working capital loans or guarantees for loans and help companies get access to additional funding. The fourth one is administrative relief. So those are those announcements that come about and purely just make lives easier for companies because of everything that's going on. So maybe it's an extension of a filing deadline. For the most part, that's what that bucket is. And then the last one are those measures that are designated for employees. So a lot of the provinces came out with emergency funding that employees who have been laid off could get access to before they could take advantage of the federal program. So a couple of key ones I'll highlight on. I mean, I could spend hours and hours talking about this, but there's some that we see people taking advantage of more than others. And the first one, of course, is the Canada Emergency Wage Subsidy, which I'll call CEWS. It's just a little easier to say. I've heard some people call it CEWS, but I'm going to call it CEWS, and that's what I'm talking about is the wage subsidy program, which is the 75% wage subsidy up to $847 a week. If a company has experienced a revenue decrease of 15% in March, 30% for April and May. And then there was another wage subsidy announced earlier, which was a 10% temporary business wage subsidy. That original one was a 10% subsidy, but was only available for a smaller group of companies, particularly companies that are eligible to claim the small business deduction. The other one that a lot of people are taking advantage of course, are all of the deferrals I previously mentioned, tax, workers' comp, etc. In Nova Scotia, there are a few that have been announced at the provincial level. The deferral of workers' comp, the deferral of government loans. For small businesses, there's been a couple interesting ones that have been announced. There's the Small Business Impact Grant that can provide a grant based on revenues in April of last year or February of this year, up to $5,000. And then the latest one is the Small Business credit and support program. So under this program, companies can apply and get a loan up to $25,000. The definition of small business for this program is a company that has had payroll less than $20,000 in 2019. And there are a couple other add-ons to that program whereby you can get a one-time grant of $1,500 and a voucher up to $1,500 to get support professionally to help you navigate and understand the impacts of COVID to your business. I'm going to stop there because, again, I could go on and on about the different programs, but if anyone has any questions about them, I'm certainly happy to field those questions. And some of the programs, I know that there's the new rent one that came out federally last week. There's a ton of questions around that one, and we're still waiting for a lot of clarification on what some of the definitions and thresholds mean, but I know that one has piqued a lot of interest of people.
Yeah, thanks, Katie. I guess, I mean, I find it valuable to hear the things that you're hearing. Things are opening. I know the wage subsidy portal opened earlier, and you're probably getting a lot of real-time feedback from people. What are the most common things that people are asking or having to deal with?
Yeah, tons of questions, and you do start to see recurring things after a while. And to your point, the portal did open on Monday, and I think by Tuesday we were hearing that there were over 44,000 applicants just within a couple of days. So it's amazing, and not surprising though, really, that companies are taking advantage of it. So the questions that I hear the most, you know, at first it was helping companies understand, you know, how do I do this? Do I do a standalone? Do I calculate it as a standalone legal entity, or do I do it on a consolidated basis? And if I do it on a consolidated basis, can I pick and choose which of the companies that I consolidate? And the answer to that question is no, you can't pick and choose. If you're going to do it on a consolidated basis, you have to include all of the entities that are in that affiliated group in that calculation of consolidated revenue. You can't pick and choose to get the best result. I get asked a lot if companies are going to be required to top up the other 25%, and if they're not able to, are they going to have to provide evidence that they can't? And if so, what would that evidence be? In the legislation, there is no requirement for a company to do that top up. Of course, the federal government has strongly encouraged any company that can to do it, but there's actually no requirement in the legislation to do so. I also get asked if it's required to show the correlation that the decrease in your revenue is related to COVID-19. And again, there's nothing in the legislation that says you have to be able to prove that your revenue decline is related to that. So long as you meet the revenue thresholds and all of the other criteria, then you're able to claim the wage subsidy. Another common question is with respect to non-arm's length employees and whether or not you can claim the subsidy for them. And the answer is yes, you can. There's a couple key things to keep in mind. That non-arm's length employee has to have been on the payroll prior to March 15th. You can't just bring them on and start paying them after the fact to claim the subsidy. And you also can't increase their wages and claim the subsidy on the increased wage. I jotted down a couple of the other ones that I'm hearing a lot. One of them is with respect to eligible remuneration, and what does that mean? What does it include? Oftentimes there are bonuses or commissions or something that have been paid. So it's important to understand the period in which that compensation or remuneration was earned versus when it was paid. So there are two types of remuneration that are important in the calculation. There's the pre-crisis remuneration and then the actual remuneration that is paid. When looking at the pre-crisis remuneration, the definition is amounts paid from January 1st to March 15th. And so if someone earns a commission in that period, but it doesn't get paid until after March 15th, then it wouldn't be included in the pre-crisis remuneration. And then the definition for eligible remuneration for purposes of the claim is remuneration for work performed in that period. So to the extent those commissions that I was talking about that were earned in the January to March 15th period get paid after March 15th, you wouldn't be able to claim those on your subsidy. I also get a lot of questions about, well, what do I do if my payroll periods don't line up with the claiming periods? And the way that we interpret it is that you do actually have to calculate what was the remuneration earned within the claiming period, whether or not that is, so you may have to prorate your payroll periods, is what I'm getting at. So I think those are the most common ones. I mean, you sort of get one-offs from everywhere. I've helped some of my clients work through the cash method versus the accrual method for purposes of calculating revenue. And then sometimes I'm finding that they weren't eligible under the accrual method, but once they look at their cash receipts, all of a sudden they are eligible, because what happened was, as soon as COVID starts hitting the news and people start to think about the implications to their business, a lot of people stopped paying their bills. So then cash receipts in companies went down significantly, almost immediately.
That's great. Thanks for sharing that. That's basically, sounds like there's a lot out there, and it could be a little more complicated than you think at first blush, and it's worth spending time for sure and having the right conversations. So we're going to move now to Brian Stewien, and Brian has spent 20 years working with companies in the value creation space. He's all about creating value through the balance sheet and through revenue, margin, profitability. So that's already been his work for 20 years, and it just so happens that the right crisis came along for him to amp things up, and is now working with clients, leading our working capital group across Canada and dealing with everybody's favorite topic on cash flow and working capital optimization. So Brian, I can imagine the last 7 weeks has been interesting for you. What are you seeing around how companies are approaching this, and also how maybe their approach has changed over the past 7 weeks?
Thanks, Sheri. Interesting indeed. Good afternoon, everyone. Thank you for joining today's webinar. I hope you and your families are keeping safe and healthy during these challenging commenced. Our conversations with board of directors and executive teams were truly focused on employee safety, business continuity plans, remote operating models, and reducing discretionary spend. All of these activities are important. They're still ongoing today, and some are being refined daily. In fact, some of these things may actually be permanent for us in the new normal. Wear gloves, wear masks permanently. I think about our manufacturing clients who are now thinking about how do they ensure that the social distancing within the facilities is maintained.
Unfortunately, I think for everyone, Brian is breaking up. Is that the same for you, Katie?
It is, and it's interesting because, I mean, Brian and I have done many of these webcasts, and that's never happened before.
Can you hear me now?
Yes.
Oh, apologies for that. So I was saying, so fast forward to today, and we still have a health pandemic, but now we also have a financial crisis with the timing and the scale still unknown. If I look at the conversations I'm having with clients today, I would say I've had a few around the new normal and reinventing yourselves, but primarily the conversations are around diagnosing the business, optimizing where possible to preserve value, and frankly, survival. With that being said, liquidity and cash management, which is very generic, is top of agendas. When I think about liquidity and cash management, the 4 key themes that have come up in the last couple of weeks are cash flow forecasting, scenario planning, working capital optimization, and cost reduction. What I will do now is I'll actually jump into each one of those categories and share some tactical insights for you. I'll start with cash flow forecasting. I would say to you, if your lenders or your owners have not yet asked for a rolling 13-week cash flow, that request is likely to be asked pretty shortly. In addition to a 13-week cash flow, a number of lenders are also asking for weekly or bi-weekly accounts receivable and accounts payable reports. These reports detailing the monies that have come in, any potential bad debts, and any payments made. Are they necessary and in line with the critical business? In addition to the 13-week cash flow and these reports, we're also seeing lenders asking for monthly financial statements. So if you haven't been doing that in the past, you may be expected as well. If I think about 3 key themes that have come up in the conversations that I've sat in with the lenders and the clients, They are, the first one being the process around which the payments are being made. So what is the frequency of the payments, and are these payments really for critical operations only? The second key theme is around the monthly burn rate. Number of questions being asked: what was the monthly burn rate pre-COVID, and where is it today? And what actions have management teams taken to reduce that burn rate? And then the third one is around the assumptions on your inflows and outflows. The lenders are actually getting into quite a level of detail there. I've seen 2 or 3 major banks ask questions around: what geographies are you focusing on? Who are your key customers? What products and services will you be selling? What is your pricing model, and how has that changed? If I shift to scenario planning, I would say to you, all of my clients I put together a minimum of 2, in some cases 3 scenarios. Typically a best case, a middle of the road or conservative case, as well as a worst case. In putting these scenarios together, they're obviously taking into account a number of different sources of information, including those that they can control and those which they can't control. If I think about the sources of data, the first one would be economic data, so commodity prices, interest rates, exchange rates. Lessons learned from previous recessions. If you have any applicable industry data, so if you have any information on what's happening within your industry or what you've seen your competitors do. And then the last one, which is an interesting one, which is around customer behavior. So we've seen in a number of industries how the customer is starting to shift their spending habits. There's been a major shift towards online. So taking this information into account is important as well. The third category I'd like to touch on is working capital optimization. If I look at all of my clients, they must probably double down the most in this particular area, only because this is where they believe that they're able to make up the shortfall if they've taken into account any financing that they've received from lenders as well as government programs. I'll go through each one individually. So from an accounts receivable perspective, if there's one function within the finance area that I've seen clients increase cross-training, it would be their accounts receivable. A couple of handy tactics. The first one is around raising invoices. Ensure that the process that you have around raising those invoices is working. Ensure that your invoices that are going out are accurate. And by that, I mean, if there's any credit notes that need to be taken into account, make sure they have. If there's any payments that you've received, make sure that you've taken them off the balance. I know this seems pretty simple, common sense, or even 101, but it is something which is important. And then once you've sent out the invoice, follow that up with a call. This is not going to guarantee payment, but at least it's going to help you proactively identify potential problem accounts and help with conversations around payment plans. The second tactic is, if you offer discount today, maybe contemplate offering a greater discount. I've seen discounts range from 5% to as high as 20%. If you're a client which takes credit cards, maybe contemplate foregoing or waiving the credit card fees. If you're finding that from a dispute perspective that you have a number of invoices that are being disputed, I would suggest maybe doing some analysis around what is causing those disputes and try and resolve the issue so that you can increase the likelihood of collection. And then finally, the last one on accounts receivable is around debtor factoring. A number of banks are still offering this option, so something to contemplate. From an inventory perspective, a couple of ideas that I've seen in recent weeks. The first one around slow moving or obsolete stock, maybe offering that for a discount or putting it on e-auctions. You've seen or you've read a number of industries are looking to repurpose the inventory that they have. If I think about my manufacturing clients, a number of them have shifted their operations to PPE. I've also seen in the food sector, food that was destined for the food services industry, so the bars and restaurants, has been repackaged and relabeled and sent to independent and some of the larger grocery retailers. From a payables perspective, some of the tactics that have been clear in the last couple of weeks. The first one is having a robust payment plan and policy. So ensuring that, as I mentioned earlier, that payments are only being made to critical suppliers. The second tactic is around mapping your critical and strategic vendors to your priorities. I would definitely encourage that you maintain that communication with your strategic vendors. I've seen a number of my clients get nasty letters back from vendors saying, we have not seen a payment in a couple of weeks. Just to let you know, if we do not see a payment, or you will not receive the same terms, and we also will not be shipping product until you're up to speed or up to balance. The third one that I would say that I'm seeing quite frequently now is clients taking supply chain financing as an option. So approaching the bank and seeing if they qualify for this particular source of financing. The fourth category that I'd like to talk about is cost reduction. As I mentioned 7 weeks ago, cost reduction was really just focused on reducing discretionary spend. Unfortunately, as this pandemic continues for a little bit longer than most of us expected, there has been a need to further look at one's costs. And the analysis that's been prepared at most of our clients is, first of all, understanding what are your fixed costs, and is there any option to change those fixed costs to variable? A couple of ideas could include, instead of owning assets, maybe renting or leasing those assets, maybe even looking at your sales force and questioning whether you need to have a sales force, or maybe that's the broker model, or even from a digital perspective, having your clients complete most of the work using self-useful tools. From a variable perspective, there are really two parts to look at. The first one would be payroll, and the second would be non-payroll. From a payroll perspective, some of the ideas include maybe releasing any contract or temporary staff who are not critical to the business. Second one would be enforcing hiring freeze and not allowing any backfill of open position. Looking at increases in bonuses, pushing those off until a later time. If you're an essential service, a couple of ideas that I've seen there is asking your staff to take unpaid leave over a period of time, so over maybe the next 4 to 6 months. I've seen some clients ask their employees to take payroll cuts anywhere from 20% to 40%. I've also seen clients ask staff to have shorter weeks, so instead of maybe 40 hours a week, 28 or 32. Maybe one last thing from a payroll perspective that you do need to be aware of. This is obviously a very sensitive area and can have some really big implications on a company's reputation, whether it's through social media or any other channels. So I would encourage, the leadership need to feel the pain as well, not just your employees. From a non-payroll perspective, as I mentioned, discretionary spend was the first area to be looked at. But now, as this prolongs, doing a deeper dive into some of your other variable costs is important. Some of my clients have looked at their sales and marketing spend and asked is it necessary at this particular time to be spending, especially as consumers continue to preserve their cash? Maybe also looking at the channel in which that spend is being sent through. I've noticed that a number of my clients are now focused on TV and digital. And even on the TV, having it on certain channels like the news, where there is a greater audience. Other areas to think about are CapEx. I would definitely encourage that any CapEx project which is currently over budget, whether from a timing perspective or from a dollar perspective, you should be reviewing and contemplating whether that project should continue. And then for any new CapEx projects, I would encourage you to think about, is it still necessary? And is there any chance to actually increase the return on investment and the payback period? So those are a select few examples. I could, similar to Katie, I could go on and on and on. But yeah, hopefully I've been able to provide you with some ideas around initiatives which can help from a rapid and a tangible cash benefit perspective.
Yeah, thanks, Brian. I'm certainly taking a lot away from this in terms of that there needs to be a plan. Obviously, there's a lot of things, and there's a long time frame that we have to work through this, and having a succinct plan and levers to pull is an important aspect of the planning, the scenario planning you talked about. And then all of these factors that you talk about, I think it comes down to a lot of your clients you've mentioned are doing diagnostics around their working capital to try to identify which of these things that you've mentioned are going to have the most impact for them. So you've done a lot of those, I know that. What's the main area, or what are some of the areas where you are seeing the most likely savings or leakage happening? I'm not sure if he's thinking or frozen. Can you hear me, Brian? Oh no.
Sorry, Katie, I can hear you now. Apologies, the connection doesn't seem to be good.
Yeah, sorry, did you hear any of that question?
I didn't. I could see your lips moving. Apologies.
No problem, no problem. I'll truncate it down. I know you've done a whole bunch of diagnostics around working capital, and you probably see some trends. What are the most likely things that people are seeing in terms of savings and leakage?
So from a diagnostic perspective for working capital, I think what we're seeing is clients are actually using this opportunity to calculate leakage. And for those of you who are not sure what leakage means, is really it's a comparison around what does your contract say and what are your actual transactional invoices saying, and then doing that difference. And I'll give an example. Like many of my clients will tell me that their accounts payable, their vendor terms are 30 days. However, when we look into the detail, it's actually closer to 40 or 60 days. So if you're able to bring it back to the terms that you negotiated, there's a real cash benefit there. So what I'm encouraging on, and many of the clients are doing, is they're using this lockdown period right now to actually do this leakage calculation so that post-COVID, they can then go back to their clients and set the rules of engagement going forward, that these are our terms and this is how we'd like to work with you going forward. Typically, when we do these exercises, we find anywhere between 10 and 20% in savings. Hopefully everyone heard me.
Yes, we heard you loud. I heard you loud and clear on the 10% plus savings. So that's something to look at for sure. Before we have about 15 minutes here left for Q&A, and we're certainly happy to take them across any dimension of the discussion we're having. So post those now. Before we jump into that, I did want to point out something that is available, and actually there's going to be another webinar on this because it has so much in terms of nuance to it. But so one of the things that Deloitte has been asked a lot about, and that there's a lot out there around disparate data, information, all of the things that are available online and in the media, and there's just a lot of information in this data age. And so one of the things that we're asked about is the economic outlooks and when the recovery is coming. And in order to address those questions as kind of in a meaningful way, we actually undertook a project internally to create this economic recovery dashboard. It's available online, free to everybody. If you just Google Deloitte Recovery Dashboard, it will come up. And what's interesting about it is that it's a real-time indicator that's updated constantly using artificial intelligence and other things that we have available to us. And it basically takes a 4 indicator. It measures recovery and economic health and all the things that go into when is a recovery coming for us across a bunch of different dimensions. And you can see the 4 across the top here. There are a number of health indicators that can be measured on a minute-by-minute basis around the number of cases and diagnoses and deaths and those sorts of things. I'm sure we all see too much of that already. And then there's an AI section. We're monitoring a lot of data that's online around things like foot traffic and congestion and sentiment online that would all be indicators of when this wave is turning or going in a different direction. There are, of course, financial indicators, stock market and money flow and that sort of thing. and then economic indicators. So all of those things are being tracked, and this can actually be broken down between geography and sector as well. So unfortunately, all of the indicators at the moment for Canada are red, meaning we're still firmly in the middle of this thing. But a lot of companies are finding this helpful to look at to make decisions for their business and for scenario planning and all the things that we've talked about today. So I won't go any further on that. There will be actually another webinar with the Chamber to go through that in more details, so that you can get the most value out of that possible for your own planning. And then before we go into Q&A, I'll just also point out that we do have a COVID hub online available to not just our clients, but anybody that has accumulated all of our ThoughtWare webinars. Our economic insights are there, and to the extent that you find that helpful, please feel free to go on there and poke around and ask any questions that you have. So Q&A. So if you have questions, please post them down below in the Q&A. If not, I think, Patrick, you have a few that you wanted us to cover as well.
I do. Yes. If I could jump into some of those, you guys can hear me? Yeah, I think so.
Yep.
Oh, you can't see me, which is probably good for you.
I can see it.
Okay, thank you. So maybe this is Katie, but if a business can pay taxes, sorry, where am I? Should they pay their taxes now, if they can, or should they wait for the new deadline? It's a pretty basic question, I suppose.
Yeah, and I think it's very...
Katie's answer might be different than mine, so we'll let her. she's a true tax person.
I say it's very dependent on the particular corporation and their situation. What I'm telling all of my clients to do is, like, understand your cash flow situation now, understand what it's going to be in September, you know, understand it to the best of your ability. Like Brian had said, do some scenario planning. And if you can pay it now and you want to, you don't need to preserve that cash for anything else, then there's no harm in that. But for most companies, they're not paying it, even if they can, and they're waiting to sort of reevaluate and see where things are at in September.
Okay. All right. Yeah, oh, go ahead. Sorry.
Well, I was going to say, I would agree with that. I think now we always recommend deferral when you can get it, especially for no cost. But I will bring in the other humanity side of it, because I was on a call with Mayor Savage last week, and one of the things he mentioned was, if you can, we are in a situation where the government is not nameless and faceless, especially locally. And his encouragement was that if you can pay and it doesn't put you at risk, that it will actually help. It will help the government, especially locally.
Yes, well, absolutely. And I did mention to the mayor that I did pay my residential taxes, which he then brought up to everybody. I didn't think he was going to do that.
No, we all know too, Patrick.
We all know, but I paid them, so at least it wasn't the opposite, I suppose. Brian, over to you. These were all great ideas. I was particularly intrigued by the idea of perhaps discounting some of your invoices to accelerate payment. I thought that was really interesting. But I'm going to kind of go in a different direction, which is you're going to do this once. What if there's a return to this? So, you know, can you kind of look at the cash flow this way, defer things, postpone things, take a look at your capital? We get back to work in a month and a half or 2 months, and then in the fall we see this again. And we're in much the same position. I mean, is this something we need to do on an ongoing basis?
Yeah, I would say to you, working capital in general is something that is overlooked by most businesses. I encourage all of my clients to dedicate time to truly understanding the strategy that you want to follow from a working capital perspective, being very clear with both your customers and your vendors on what that strategy is, and constantly reviewing it. Most of my clients have put in place working capital reports that they monitor on a monthly basis. And if there's any discrepancies or variances, they then follow that up. And if there's any particular customer or vendor which is a problem child, then working with them individually. So I would encourage this as continuous and not just necessarily COVID related.
Right. Okay, perfect. And Sheri, back to you. How are businesses repositioning themselves, or are they repositioning themselves? I mean, we're 5 weeks into this. Are companies thinking about what they need to do in this new normal for the next year, or are they thinking a couple of years out, or what are you hearing for businesses?
Yeah, so well, I think that businesses themselves are across the board. There have been very proactive examples. I can tell you a little bit about what we're doing, which is actually also in our on our website there. We are looking at a number of scenarios, at least 3 at a time, based on the most current information, mapping out a strategy that is never really set in stone until you get close enough to know what's really happening. So that's the interesting thing too, is the scenarios have to be very flexible, and the levers that you're going to pull, you may have 10 levers available to you, for example, for managing your workforce. You know, are you going to do layoffs? Are you going to do work reduction options? But when you're going to do those and what's going to transpire between now and then, I think it has to be left open to some extent. So it's a constant ongoing planning around scenarios and levers, and knowing where you're going, but not exactly knowing when. And for the most part, I think that there's a 4 to 6 month very real period of planning. So you know what is going to happen in that 4 to 6 months. And then beyond that, it's the reality of a likely recession, a likely, very slow return to normal, and possibly a recurrence of these events. And so the high level scenario planning for that is also happening in most businesses.
Right. Okay, great. Thank you. I'm sure you're all talking to the various businesses that you deal with in your particular areas, I suppose. But what are you hearing? And the government, I must say, I have to congratulate the government on being very responsive and listening to when business and industry are suggesting changes to the programs that have come out. But are you hearing there are still gaps in some areas that you think businesses would like to have resolved in the short term?
I'm definitely hearing that with respect to the new commercial rent program that was announced, that was focused on small businesses. There was a lot of comments and feedback on that it just doesn't go far enough. And I've also heard that they are looking at not only clarifying what is included in the program that has been announced, but a second program that would capture more larger companies.
Oh, really interesting. Larger companies. Okay.
Yeah.
And is that
area to make more companies fall into the program?
Oh, okay. Oh, that's interesting. Okay. Sheri or Brian, any things that you're hearing?
I would add the travel hospitality sector are asking for more help. I mentioned earlier that we're working with a number of airlines. They feel like they could get some more help. Yesterday, I was actually with a restaurant owner of a number of chains, and they would like to get some more clarity around what does social distancing look like in the future. So many of them are concerned that today their restaurant can take 80 occupants, but the government may be looking at 40 or 60 individuals. The bar area may be off limits. So maybe just getting a little bit more insight into where the government is thinking. That's not necessarily just financial, but that's also operational, so that they can start to plan forward on how do they work in the new norm.
Okay, that's great. Yeah, that's great. Great advice. I've been looking at a sheet published, or a group of sheets published by the Canadian Centre for Occupational Health and Safety, and there are some good resources there as well. Because I know there are a number of people on the call, I recognize the names, who are in the hospitality area, and there's some good guidelines there actually. But I'm sure you guys can help with that as well. We're coming to a close. Are there some things that you'd like to leave people to think about as we go?
I would say that looking ahead and not. I think we realize now there was some sentiment, I think, early on in this crisis that this scenario was going to play out as a passing storm, meaning we just have to hunker down and weather through it, and then things will resume. Most of the thought leaders in the world would say that is not what's happening, and that's not what's going to happen. In fact, we're in for a prolonged period of adjusting, and not just in the short term, but for subsequent waves, adjusting for a new normal. And so making sure that that if companies have been slow to respond or have been taking the approach that as long as I have 3 months of capital, I'm okay, I think now is the time to really start saying, well, that's not true, and need to think about the new normal, think about what implications are going to be different for my business going forward, not just through this hunker down pandemic period, but afterwards as well, and preparing for that in a proactive way and getting ready for how they're going to return to work. When you asked about gaps, that's what came to my mind is most businesses are going to be faced with new protocols and PPE requirements and tracking and tracing possibly, and things that we have never done before, and to be ready to do that so that we're not missing opportunities when they arise, and also be ready for reacting to the next wave before we get to a vaccine. And then, of course, even if all that was fixed, we're all still going to deal with a recession and the impact of the economy. It's irreversible in some ways at this point. Right. So spending the time that you have to think that through and really get the planning in place.
Okay. Well, that's great. Well, thank you very much, everybody, for joining us today. So thank you very much, Sheri and Katie and Brian, for joining us. I want to let everybody know Deloitte has already committed, although you may not know that, to another session on May 8th, where they will go into more detail around the dashboard. And hopefully there'll be some more green on the dashboard and less red.
I hope so. I watch it every day looking for a little yellow would be nice.
Yeah, and I would really encourage everybody to take a look at that dashboard. I find it very helpful. You can drill down, you can actually look at cases per 1,000, if I'm getting it right, by province, which is really helpful to understand where the provinces really are, particularly Nova Scotia, as we compare ourselves to other provinces. So I really encourage people to take a look at that. So thank you all for attending. We're hosting more webinars every week. Let me turn this way, hosting more webinars every week with experts in cybersecurity, banking, mental health. And as I mentioned, on May 8th, Deloitte will be back again to do a deeper dive into the dashboard. Please head to halifaxchamber.com/events for a full lineup. We've also recorded this webinar, and it will be available to all attendees shortly on our YouTube channel, Halifax Chamber. And I think, Sheri, you had said that the slides will be available, so I don't know if we'll send those out. I suspect we probably will.
Yeah, we can make the slides available, and we know someone has asked for them, so we'll certainly make sure they get them.
That'd be great. Before we leave, I'd like to mention we have a short survey out right now, which will help us shape future webinar content. I'd encourage you to take a look at that. I believe it went out yesterday in our e-newsletters, which would have gone out around 11 o'clock yesterday morning. We want to know what type of webinars you'd like to see and what type of content would be most helpful. So take a look at that survey, and thank you very much, everybody. And thank you, of course, again to our panelists. I'm virtually applauding for you right now.
Great. Thank you so much. Stay safe, everyone.
Thanks, everybody.
Appreciate it. Bye-bye.